Okay.
So welcome to Central Bank, to this MPC press release. It was yesterday we had a whole day meeting on looking at the global economy, emerging developing countries down to Africa, down to the Gambia. The governor will lead us with the press release of those discussions we had. This morning we had also a decision making of the policy rate. With that, I hand over to the governor to give us the press release on the February 22nd meeting yesterday. Thank you, sir.
Thank you very much, Dr. 𝗧𝗵𝗵, First Deputy Governor. Good afternoon, colleagues, members of the MPC committee, and good afternoon, executives from the commercial bank, in both the international and domestic economy. And this morning also we met to finally make a decision on the monetary policy stance of the central bank for the next 3 months, the next quarter. And the Monetary Policy Committee, MPC of the Central Bank of the Gambia, met Tuesday, February 22nd, 2022, to review economic and financial development. Subsequently, recent global developments are adversely impacting on the global recovery, as evidenced by the weaker than expected growth. Global growth is forecast to be slower than previously projected on the backdrop of the breakout and spread of the Omicron variant, continued money supply chain disruptions, increasing energy prices, and the imminent the International Monetary Fund, that is the IMF, forecast global growth at 4.4% for 2021. Down in advanced economies due to supply disruptions in the United States, slowdowns in the housing sector in emerging market economies, and the lower new investments in real estate, and unanticipated lower private consumption in developing economies. Although the near-term growth prospects seems to be slightly stronger than earlier envisaged, these prospects are clouded with uncertainties such as the resurgence of the COVID-19 pandemic, driven by new and mutating strains of the coronavirus, persistent supply bottlenecks, high and rising inflationary pressures, and the dwindling monetary and fiscal stimuli. It is anticipated that the shock dragging the 2022 growth will disappear, and global output in 2023 would be much more robust. In advanced economies, growth in 2022 was downgraded to 3%, attributed to adverse developments. Growth in Germany, Canada, and the UK were marked down by 0.8%, 0.8% again, and 0.3 percentage points, respectively. The emerging markets and developing economies region were not spared from the downward revisions. The region was slightly downgraded to 4.8%, that is 0.3 percentage points from the October forecast by the IMF. The downward revision considered disruptions in the housing sector in China, weakened activities in Malaysia and Indonesia. Growth in 2023 is expected to pick up due largely to improvement in credit growth, investment, and consumption in India. On the domestic economic development, we first look at the real sector developments, and the information there is that the Gambia Bureau of Statistics estimated the real GDP for the economy in 2020 to have contracted by 0.2% relative to an expansion of 6.2% in 2019. The noticeable contraction in growth could be explained by the impact of the COVID-19 pandemic, whose episodes the world is still witnessing. The economy is forecast to rebound in 2021, aided by the monetary policy measures adopted to mitigate the effect of the virus and subsequent relaxation of the pandemic measure. Consequently, the IMF, in collaboration with their Gambian counterparts, estimated growth to rebound to 4.9% in 2021 and 6.5% in 2022. This is predicated on anticipated vaccine rollout and a return to normal economic activity in 2022. The quarterly business sentiment survey of the Central Bank of the Gambia indicated sustained confidence in the overall business activity in the first quarter of 2022 relative to the fourth quarter 2021, attributed to higher sales and profitability. Most respondents opined that economic growth remained unchanged in quarter 4 2021 relative to quarter 3 2021 on account of unchanged business perception in the manufacturing, financial, and insurance sectors during the period under review. Majority of the surveyed businesses expect growth prospects to improve in the review quarter due to perceived improvements in manufacturing, financial, and trade sectors. On prices, most respondents perceive inflation to edge up on account of increase in input prices due to supply constraints. Exchange rate pressures are also anticipated to persist for the quarter under review. However, respondents are satisfied with the manner the bank sets its short-term rates to curb inflation. On external sector developments, provisional estimates of the balance of payments revealed deterioration in the current account balance. The current account deficit increased to US $94.1 million, that is 4.6% of GDP in 2021, from a deficit of $86.6 million, 4.6% of GDP in 2020, reflecting shortfalls in income, service, and current transfers. The goods account, that is exports and imports, the deficit in that account narrowed by $62.3 million to $449.5 million, 22.0% of GDP during the review period. The improvement in the deficit was occasioned by decline in imports associated with structural bottlenecks at the port of Banjul. Conversely, the deficit in the services account balance expanded significantly to $13.9 million in 2021 from a deficit of $3.5 million. Gross official reserves at the central bank stood at $552.93 million, or 8.8 months of normal import cover. At end December 2021, rose by $182.68 million relative to its level at end December 2022. On foreign exchange market developments, activity volumes of foreign currency in the foreign exchange market in the year to end December 2021 rose to $2.53 billion compared to $2.17 billion in the comparative year a year ago. Correspondingly, the sales and purchase of foreign currency represented by demand and supply increased by $0.17 million and $0.19 million respectively. Inflows of private remittances continue to be the main supply of foreign exchange in the domestic foreign exchange market in 2021. Remittance inflows increased markedly to $776.67 million in December 2021 from $589 million in December 2020. The exchange rate of the 𝗛𝗚 remained stable and resilient in 2021, supported by sustained remittance inflows. In the 12 months ending December 2021, the 𝗛𝗚 depreciated against the US dollar and pound sterling by 3.3% and 0.2% respectively, while appreciating against the euro by 2.3%. On government fiscal operations, provisional data on government fiscal operations in the year to end this $3.4 billion or 3.6% of GDP in the corresponding period of 2020. The increase in the fiscal deficit is explained by the significant decrease in grants, which more than offset the decline in government expenditure. Revenue and grants mobilized during the review period decreased to $17.7 billion, 16.6% of GDP, from $20.3 billion, 21.5% of GDP a year ago, attributed to a significant decline in grants disbursed. In the 12 months ending December 2021, government adopted fiscal restraining measures that yielded the decline in total expenditure and net lending by 8.3% to $21.6 billion or 20.4% of GDP, relative to $23.6 billion or 25.1% of GDP in the same period in 2020. Both declines in recurrent and capital expenditure by 5.5% and 15.6% occasioned the reduction in expenditure and net lending. Developments in the banking industry. The banking system financial soundness indicators remain robust, characterized by strong capital base, high liquidity, and lower single-digit non-performing loan ratio. In the year to end December 2021, total assets of the industry increased to $73.06 billion from $58.82 billion in the same period last year, owing to increases in balances due from other banks, investments, and loans and advances. All banks were well capitalized, adhering to the minimum capital requirement throughout the period under review. In addition, The industry sustained high liquidity ratios quarter on quarter, averaging 92.0% at end December 2021, slightly below the 2020 ratio of 93.5%. Similarly, the risk-weighted capital adequacy ratio declined to 26.6% in 2021 from 32.6% in 2020. The non-performing loans ratio improved, mirroring the improvement in asset quality. The ratio decreased by 1.2 percentage points to 5.2% at end December 2021. The industry's capital adequacy ratio stood at $52.52 billion, increasing slightly by 4.2% compared to end September 2021. This is due to growth in all components of reserves, statutory, undivided profits, and other reserves. The non-bank financial sector is an important conduit for financial inclusion. It aids in the extension of financial services to those that are excluded from the conventional banking system. Mobile money financial services in particular are rapidly expanding the digital financial cash and bank balances. Capital increased by 31.0% to $378.13 million in December 2022. Mobile money financial services similarly grew in terms of customer base, but declined in terms of transactions. Year on year, the value of cash in and cash out transaction volumes decreased by 20.8% and 20.7% respectively, while the number of account holders surged by 93.8%. Domestic debt developments. The outstanding stock of domestic debt increased to $37.19 billion, or by 7.1% at end December 2021, compared to 4.3% growth in the same period last year. The increase in domestic debt was on account of an increase in bond issuance resulting from the implementation of the debt reprofiling strategy. Consequently, short-term securities contracted by 2.1% and 5.3 percentage points as a share of domestic debt. The yield in domestic security market during the review period declined significantly due to the accommodative monetary policy stance of the central bank. The 91-day, 182-day, and 364-day Treasury bills yields decreased to 0.72%, 0.71%, and 1.55% in December 2021, from 2.75%, 5.03%, and 7.30% respectively in December 2020. Monetary developments. Growth in money supply in the 12 months ending December 2021 slowed to 19.5%, slightly below the 22% growth in 2020. This is attributed to the moderate growth in the net foreign assets of the banking system whose growth slowed to 19.0% in 2021, relative to 45.0% in December 2020. Growth in the net domestic assets, however, expanded markedly by 13.0 percentage points to 20.0% for the period under review. Similarly, the increase in reserve money moderated to 13.6% at end December 2021 from 33.9% recorded in the corresponding period last year. The slow growth in both currency in circulation and reserves of deposit money banks contributed to the slow growth in reserve money. Price development. The consumer price inflation increased by 5.0 percentage point month on month to 7.6% in December 2021 from 5.6% in December 2020. The acceleration in headline inflation was mainly driven by the rise in food prices associated with supply constraints and the structural bottlenecks at the port of Banjul. Food inflation inched up by 1.0 percentage points to 10.2% in December 2021 from 9.2% in September 2021 and 7.0% from the same period last year. Oil and fats, sugar, jam, honey and sweets, and bread and cereals were the main drivers of annual food inflation. Similarly, non-food inflation also accelerated both on quarterly and yearly basis. It rose to 4.9% in December 2021, relative to 4.8% in September 2021 and 4.4% in the corresponding period last year, attributed to increases in prices of alcoholic beverages, tobacco and narcotics, health, housing, water, electricity, gas, and other fuels. The near-term forecast shows that a reduced consumer food basket will be the main driver of subdued inflationary pressure in the first quarter of 2022. However, the risk to the food inflation outlook is the exchange rate pressures, rising global transportation costs, and volatile global commodity prices. In view of the above, the Monetary Policy Committee observed the following. The committee noted the downward revision in the IMF growth projections for 2021, premised on the forecast downgrades in advanced economies and led by the stronger near-term prospects among some commodity exporting emerging markets and developing economies. Despite global growth prospects, risks to the outlook remain as uncertainties surround the efficacy of the COVID-19 vaccines. Unequal access to vaccines and vaccine hesitancy has left many people susceptible. The committee noted that global economic recovery has impacted on domestic developments as evident in some macroeconomic indicators. Real GDP growth for the Gambia is forecast at 4.9% in 2021, up from a contraction of 0.2% in 2020, premised on ease in COVID-19 restrictions and rebound in tourism. The committee also noted the increase in food prices due to the increase in annual food inflation resulting from supply disruptions and cost-push effects of the structural bottleneck at the port of Banjul. The committee noted with concern the rising trend in inflationary pressures from October 2021, mainly reflecting increase in global food and energy prices, as well as the structural constraints at the port. However, the near-term forecast suggests that inflationary pressures are expected to trend upwards moderately in the first quarter of 2022 before slowing down thereafter. The committee noted the recent uptick in headline inflation and considered that most of the causes are transitory, given the gradual ease in supply bottlenecks as the global economy rebounds. Furthermore, the committee noted reserve money, the bank's operating target decelerated by 20.0 percentage points to 13.6% in December 2021. In December 2020, it was 33.9%. The decline in reserve money, the committee are of the view that increases in prices is not a monetary phenomenon, but rather supply-driven. The committee noted the significant increase in private sector credit from 0.8% in December 2020 to 20.7% in December 2021, and judged that such a development need to be sustained to enhance the recovery process of the economy. Coming to the decision of the committee, taking the above factors into consideration, the Monetary Policy Committee has decided the following: maintain the policy rate at 10%, maintain the required reserve at 13%, and maintain the interest rate on the standing deposit facility at 3.0% and the standing lending facility at 11%. That is the MPR plus 1 percentage point. The Monetary Policy Committee will continue to closely monitor the situation and to take further necessary action as and when the situation requires. The next meeting of the Monetary Policy Committee is scheduled for Wednesday, May 25, 2022. The meeting will be followed by the announcement of the policy decision on Thursday, May 26, 2022. Thank you for your attention.
Okay, we are open to few questions. If you have it, you announce your name and the press you have you represent.
Well, in simple terms, what the report tries to tell the Gambian public is that the Gambian economy is doing very well. We told you in the report when the pandemic hit, we were expecting, like any other economy in the global economy, that there will be a decline in growth. And what the report is saying, the report is looking at, we met in November 2021. The Monetary Policy Committee meets every 3 months. And from the last meeting, we are telling you the developments in the global and domestic economy. Now, in terms of growth, the economy grew or contracted from 4.9% in 2020, from 4.9% in 2019 to 0.2% in 2020, and we are saying in 2021 is going to grow to 6%. So that's an improvement in growth. That means the effect of the coronavirus from the growth rate of 4.9% in 2019, it declined, the economy contracted, but because of the supporting measures, both monetary and fiscal policy in particular, the fiscal policy implemented by the government to fight the coronavirus and also ensure that we maintain macroeconomic stability, there was expansionary fiscal policy as obtained in every economy in the globe. This was supported by monetary easing. So central bank eased monetary policy. Interest rates were reduced. The reserve requirements of commercial banks were also reduced. The intention is to release enough liquidity in the economy to support the fiscal expansion so that the impact of the coronavirus on the Gambian economy could be mitigated. And the economic decline, I was Permanent Secretary, Minister of Finance, when the corona hit. And at first, we estimated that the decline in the Gambian economy was going to be around 3.2% or so. But because of the measures taken, I told you in the press statement, the decline in 2020 was 0.2%. And then the intention of those policies is not only to maintain macroeconomic stability, but to also help in restarting the economy to kickstart growth. And growth, we said in the statement, growth is taking place, and for 2021, we expect growth to be 6.2%, which is an increase in growth. And the growth, what we are trying to do is not only a pickup in growth expansion, but we want this growth to be resilient, to be able to withstand the next shocks, and also the growth to be broad-based, so that everybody shares in this growth prospect. We did also inform the general public that, yes, there was an increase in debt, but increase in debt is not for consumption. It's reprofiling the debt of the government, the public debt. The intention is these are legacy debt from the previous regime. Now, what is happening in those days, the government was issuing a lot of treasury bills because they are to finance the fiscal deficit. Those are short term, 3 months, 6 months, 9 months. And that the interest payment for those things are frequently reoccurring. And they're sucking most of the revenue generated currently to pay for those old debts. And in order to create fiscal space so that this growth can be sustained and also expanded to be broad-based and increase the growth rate to reduce poverty. If we are to reduce poverty in our part of the world, we have to grow at around 8%. So to be able to reach that level so that we can dig ourselves out of poverty and attain middle income state, we have to increase the growth. And that means government spending should also be part of it, accelerated. So that's why what we are doing, reprofiling the debt, issue medium to long-term bonds, 3 to 5 years. What that will do, it will give government breathing space. not to pay anything on 3, 6 months, or 1 year. It can stay for 3 to 5 years. So those monies, those are the ones we are using to pay off this short-term debt. So you will have your revenue to spend on improving the quality of life of the Gambian people. And as a result of that, and coupled to that, government is now borrowing, is not borrowing to finance the deficit. That's why interest rates, we told you in the statement, have decelerated from 2 point something in some profile is 0.7, 0.7 to 0.71, and I think the 1 year is 1.55. Now on the balance of payment, that is the external sector development. That is what Gambians, what that measures is Gambia's trade, the trade balance, which is imports and exports. We told you that the trade balance shrink a little bit because of the decrease in imports. And then the services sector development also is there. Then you have the current account balance. And we explained to the public the developments in that area. Now, turning to monetary developments, we also want to inform the general public that in terms of central banks' monitoring of the economy, to ensure that what the economy needs is the right money we are supplying. If you supply more than what it needs, you create inflation. If you supply less than what the economy needs, you choke the economy, it will not grow. And that's why we constantly, sometimes daily, as we reach the end of the quarter, we daily look at these monetary indicators to ensure that we set ourselves some quarterly targets. So we monitor them to ensure that we are able to hit our targets. So, and there, the reserve money, that is what central bank controls directly, because that's what we print money and issue. And we know what the growth rate is and what money the report. It decreased from 33% to almost 14%, 13.6% year on year from December 2020 to December 2021. What that indicates, during, I told you, when the pandemic hit, the central bank and government expanded fiscal policy to increase spending. Central bank was on relaxed monetary policy, increased liquidity, money supply. Now, because we are recovering, but we have to do it in a balanced way so that we don't choke the recovery. And also, we have to ensure inflation is not out of control. So we try to reduce money supply in a very gradual way, measured manner, so that, because right now, the priority is to sustain the recovery and make sure it's resilient. We are watching inflation, but we know in-house there is a threshold, a ceiling, where if inflation passes that, then it's disruptive to the economy. But below that, we can sustain that level of inflation as anywhere in the world right now, and also that is to ensure that growth is taking place and is sustained and resilient. On the foreign exchange development, the volume of foreign exchange has increased. That is the money, foreign money, that is in the forex market. And this is largely supported by remittance inflows. Monies from Gambians living and working abroad, what they send home for consumption, for construction of houses, investment, you name it. Okay? Now, that liquidity in the system, mainly because of that, plus other supplies from exports and others, the volume of foreign exchange in the forex market increased. That helped also to make sure that the exchange rate is very stable. Inflation, we explained that inflation has recently picked up, and this is definitely a reflection of what is happening in the global economy. Even the International Monetary Fund, in their latest VO update, mentioned that inflation globally will be on a sustained increase this year and then later decelerate. The reason is that because of the COVID-19 pandemic, there was, and the restrictions and all that, there was shock to supply chains. So shock on the supply side. At the same time, there was this monetary accommodation globally, relaxed monetary policy. So that's what is catching up with us. And that's why some developed countries, we mentioned in the report, are trying to normalize monetary policy. What that means in countries like US and others, they've now reversed policy. They are on contractionary monetary policy gradually on a measured pace to ensure that it doesn't affect the growth of their economy. So that also is happening. As a result, inflation, like I said, we looked at the chart yesterday. In our sub-region, inflation is going up in most countries. I believe it was Nigeria and which one? Nigeria and another country, I cannot recall, that had slight decrease in their inflation. Otherwise, in the ECOWAS region, all other countries, inflation is trending upwards. But this is transitory. It will eventually, for our economy, it will eventually decelerate. And that's why the committee thought, if we thought the inflation that is happening is going to be sustained and continuous, and it will affect the equilibrium in the economy, we would have increased interest rates to reduce inflationary pressures. But we thought at this time, since the inflation, the causes there are transitory, and according to our model, after the second quarter, it will start declining. That's why we thought it prudent to maintain the rate where it is and allow growth to be sustained and also to be resilient and move on. What next? I think this is, in a nutshell, this is what we are trying, the message we are trying to send to the Gambian public, that the fundamentals of the economy have improved and they remain strong, and that whatever is happening, we are watching, we are aware of it. In the view of the Monetary Policy Committee, we should maintain the rates the same to sustain the growth momentum.
I think
the period covered by the report is the last 3 months. And then we look at it also, what happened at the end of December. These are quarterly economic activities that we looked at. End of December 2021 compared to end of September 2021, because we've dealt with, in previous monetary committee meetings, we've looked at the quarterly developments in the previous quarters. So we looked at end December 2021 related to end September 2021, what are the quarterly developments? And then you look at, again, December 2021 relative to December 2020, then that will give you information on annual developments. But in between, we sometimes, for some models, like yesterday, one of the models looked at 11 years ago, what was happening, to be able to inform the future. And then we don't just stop at what happened historical, we also look at what is happening to set monetary policy.
okay, I think
Yes, please.
I have a quick question.
Yes.
That is on inflation.
Yes.
You predicted that
sorry, your
inflation
name,
is going to trend upward. Sorry, I'm avoiding from the standard.
Yes.
So you predicted that inflation is going to get upward in the first quarter of 2022.
Mm-hmm.
And according to the factors that are responsible for inflation, the structural growth rate that we find reports and the global rising trend of food supply chains.
Yes.
So, but in the case of the Gambia, don't you think this inflation is here to stay for the meantime? It's going to be sustained, because when we talk about the bottleneck at the buying reports, they are still there, and we've not seen any manifestations that these bottlenecks are going to be removed. And now people are resorting, importers are resorting to the ports of Dakar to send their goods that are destined to Gambia. And as a result, the price of food commodities, to me and to a lot of Gambians, are here to even if the international supply chains are easy, there are no guarantees that the bottleneck at the banded ports are going anytime soon.
That is not correct. That statement is not correct. I can tell you, we looked at it. We are informed by many things. Yes, the supply chain issues are there. And that's why it's not only supply chain and the structural bottleneck at the port. There are a lot of factors that affects inflation. What I read, so that the message is clear, is the main factors that affect inflation domestically. You have money supply and other things. The reason why we said here, like I said, we look at information and what is happening globally, because what is happening globally affects us domestically, because most of our food that we consume here, not only food, clothing, textiles, machinery, medical supplies, everything is imported. So what happened in those source countries in terms of price development and other factors that affect their prices is imported here. You see, that is the global thing, and that's why we said supply chains and improvements as the global economy opens up. Those economies increase, the economy grows, their price levels are going to, we look at their inflation to show also what they are saying. Now coming to Gambia again, dealing with the ports. The ports, yes, is a structural bottleneck. The reason why we call it that way is that factors affecting inflation, we can implement policies that would reverse the increase in prices. We've done this many, many times. You wake me up from sleep, I can tell you what we need to do to bring inflation down to our medium-term target of 5%. And we have credibility on that, that when we say we are going to reverse inflation, it will come to below 5%, it happens. And before the pandemic, if you look, they've secured funds to expand the jetty. That is the main problem, because to reduce the waiting time of ships. They've even, I was told yesterday that the bidding for the contract, the shortlisting was done. Did they say contract was awarded? Yes, somebody informed us that the contract was awarded, and the environmental study is ongoing, according to the information we got. So the work to fix those structural bottlenecks are there. So what you do in your model, you look at variables that would affect, you put them, all those variables there, what happens to them to address the rise in inflation. And then it will tell you when inflation is expected to go down. So this is not a permanent thing. And not only that, to address the supply constraint, government is trying to do something about that. And that is to try and see, and central bank is very much in this. That's why this distraction that is going on, we don't need that. We restructured the central bank and created a development finance department. The Central Bank of the Gambia is created and mandated, or is mandated to do 4 things in our act: price stability, exchange rate stability, stability of the financial system, and also participate in the economic development of the Gambia. The 3 objectives, we've been doing very well, and we have good credibility on that. Even within the region, the WAMS zone, that is the West African Monetary Zone, the single currency we are trying to achieve. In terms of achieving the convergence criteria, Gambia is always among the top. And especially on inflation, we have the lowest inflation rate in that zone, even currently, under this pandemic. So what the central bank is trying to do now is to participate in that 4th objective, that is participate in the economic development of the country. We have, like I said, created development finance department, and this year's budget, which the board approved in December, there is a quantum of money there that we want to use to support certain sectors of the economy. so that we are full food self-sufficient. The first area is agriculture, rice production, animal husbandry, and also poultry farming, fish farming, and horticulture. We want to support those things so that we have a target that is a 5-year program to ensure that after that 5 years, we don't import rice again. We have the land, we have the water, and we have the labor. We just have to organize ourselves, be creative, and attack this thing. And we think we can do it. We have the resources. We want to create a capital market. This country needs money to make, for these developments to happen. You need an avenue where you can have money that can be patient. Right now, the commercial bank executives are here. The monies they are receiving, most of it, bulk of it, is short-term deposit. And if they want to go into lending long-term, medium to long-term, there will be a mismatch in their balancing. If you have your money there for 6 months, you come and say, Trust Bank, sorry for picking on you. Give me my money in 6 months. You come back and they said, sorry, we've lent it out to Director Wada. He has not paid back. What do you think you will do? So we don't want that. To avoid that, we want to create a development bank or an investment bank where you have money that can be patient 5, 10 years, 15 years, 30 years even, to lend to the agriculture sector, the production sector, industries, manufacturing, energy sector, infrastructure. That's what we need. And the capital market also, once it's set up, you'll be able to attract investments from abroad by what the shares that or equity that companies float there. Private money outside can come in through that. We want to do different things, and we have the resources. We have the human capital, and we've programmed ourselves to do to kickstart the economic transformation of this country. And it's starting this year. In a couple of months, you will see the Capital Market Authority will be created. A few months after that, we'll do some training because we have to sensitize and we have to train people who will be, they will be the supervisor and regulators of the capital market. Participants in the capital market will have to be trained also. If you want to invest in my company, what you want to see first is my audited balance accounts. So we want to make sure the businesses are organized, everything is set, and the market takes off. And very soon, you'll see the creation of the capital market, and things will happen. The central bank, what we're going to do, we will provide certain facilities to businesses in this country to make sure this happens. We have to move away from bending to farm, to sitting on whatever we want to produce, we have it in large quantity. And that's what we want to finance. It's not money we are giving to people free. Where we participate in some of these, in terms of holding equity, we kickstart that project. Once it's up and running, stable, we withdraw our money and offload in the capital market. Then by that time, private sector participants are sure that, yes, this thing is out and working, and then they will buy those shares, our money come back. It's the Gambian people's money. But you have to use it to also improve the quality of life of the Gambian people. There's no use putting that money and you have it like what they have called in 𝗏𝗏, like living. How do you call it? Picture hanging. No. If we give loans to small and medium-sized businesses so that they can grow, whether individually or collectively, and form a company or an industry, is through these microfinance or even banks. We give it at a rate, subsidized rate. Our intention is not to make profit, but to make sure we transform the economy and there is growth, we create wealth and improve people's income and quality of life. When we give that money to banks or microfinance companies, we tell them a very a minimal rate. That's what we are giving it to them. They put their small margin and their service charges and give it out. Right now, the interest rate that is in the banking industry, which company will be able to borrow that on large scale and grow and help to produce and employ people in that large scale to what we need to address poverty in this country? It's not there. And that's why private sector growth has been slow. So you have these kind of things. I mean, we come in to push. When the economy grows, everybody does well, even the banks. That's when they make money most. Just like the economy is recovering, we told you in the statement, private sector growth moved from 0.8% last year, December 2020, to 20.7% December 2021. Because businesses who were hurting before by their cash flows, nothing was working. Now things have turned. The economy is, the stability was achieved. There is growth now. Businesses are opening. Restrictions are lifted, you know. So they see a prospect. They are borrowing. And that's what we want, development through private sector led, not government coming in. Government is inefficient in business. So that's why you don't see the likes of NTC before, or what was this one called, during 𝗵𝗲𝗃 time, the youth enterprise, those kind of things. You don't see them. We don't want to go that route. So in a nutshell, what we are telling you, this inflation is not permanent. It's going to decelerate. And like I said, we have good history of that. Before I came to these positions now, I was the director of Economic Research Department. We used to have inflation in the double digits when we had the crash in 2002, 2003. And we worked hard to fix it. Interest rate was jacked up. The exchange rate of the dollar to the dollar was at $30. But when we implemented the right fiscal and monetary policies and did some structural adjustments, the exchange rate came from $30 to $18, $19. And then the interest rate also declined significantly. Lending expanded. So we are not just saying that inflation is going to decelerate. It's our credibility, central bank. And our first objective is to maintain price stability. And we have to deliver that to the Gambian people. I can assure you that. Yes.
Thank you. So we'll be here for a long
yes.
now, and we are supposed to go for another...
No, allow him. Huh?
Yeah, can we have
yes.
one or two questions? Yeah.
Okay. Yes, we are going to have another press conference after this.
Yeah,
so I'll take yours, and then we can allow the executives to go, and we continue. Yes, please. Yes. Yes.
So yesterday the National Assembly and the other one for the Islamic Bank in the tune of $14 million.
Yes.
So the question now is how would the payment of this loan affect the economic growth efforts of the country, as you said, trying to transform the economy?
Yes.
Thank you.
Yes, I know the loan you are talking about. I was part of the negotiation of that loan when I was Permanent Secretary, Minister of Finance. That is this battle-hardened highway. The battle-hardened highway, right now, if you want to leave Turntable to come to Banjul, how long does it take you? You've seen when the project was awarded to the contractor, and I think the initial disbursement was made. You've seen how wide the road is now, without anything. Just remove those structures on the road. Can you imagine if the 3 lanes are there? It will open up the bottleneck in terms of infrastructure in this country. What that would mean, more economic activity will happen, and by that increase in economic activity and the efficiency of doing business in this country, the economy will grow. The expansion will be massive. And with that expansion, that's a growth in income. revenue generation would be increased massively. And over time, it's easy to pay this loan without much problem. And remember, this loan, they are soft loans. 35% of every loan is a grant. The rest is the loan, and they are low interest rates. We ensure these interest rates are very low, and the repayment periods are long, 20, 30 years or so. I forgot the actual period. But these are 25 years. So these are long-term loans. So taking some of these loans, concessional loans, like the ports project. The ports project would have gone take off, and this port would have 1 year of development in terms of constructing the jetty would have happened. Why we did not take that loan? Because of the terms of the loans were unfavorable. The interest rate was high, the repayment period was short, 10 years. It's not wise to do those things. With the help of IMF, we were able to get a softer loan. 15 million of that is grant. The rest is a soft loan of very low interest rate. As somebody correct, I think the first 10 years is interest free, if I have it right. And the next 10 years after that is 1%. So you can take this kind of cheap money, develop your infrastructure, and you will be able to pay it easily because of the increase in income, the growth it is going to take. It's not unique to the Gambia. When I was at the IMF, I won't name the country for confidentiality. I was the desk officer for that country. Their debt to GDP ratio was much higher than this country. And they were a post-conflict country. To contract loans, remember we are in an IMF program. Certain loans you cannot touch. That country also, they were in a similar situation or worse than us. But the fund allowed them to take this kind of loans. Their debt to GDP ratio was, for them to take another loan was unsustainable. But they allowed them. Why? Because at the fund, what we look at when I was there, what the fund looks at is the economic benefit to the country. You know, that's what you look at also. And then allow countries to take that, because you know once they take that loan and they put it in the productive sector, that would massively expand their economy, and it will be easy. That is reprofiling the debt from short end of the market, 3, 6 months, 1 year, where your revenue is busy paying for those instead of going to the productive sector or supporting social programs. So that's why countries do this thing. You try to be creative, and then issue bonds that are 3 to 5 years. That gives you breathing space. You pay off these other short-term loans, and these are legacy loans, not now. And then you have space to invest, expand the economy, revenue increase. By the time those loans mature, you have enough money, you can pay it without feeling it. But right now, these things are constraining us. That's why we have to think outside the box and also think the way we do business to move on.
So I think at this convenient moment we can end here, and we are going for another press conference and allow the executive to read. So the press can stay. And thank you all the CEOs, representatives of the line for your attendance.
Thank you very much. Well, this thing is hot here. Is this working? Why? Naka, madam.